Hello, this is John McBride, Realtor with Caldwell Banker Harper in Walston in Raleigh, North Carolina, coming to you with your August 2018 monthly market report. Please like and subscribe to my channel. This way you'll receive each update with real estate news that's important to you. And please leave a comment below if you have any questions or have any topics that you would like to see addressed. Now on with the report. We have good news, actually great news in the fact that there's been a shift. There's not much of a turn, but it is a turn. And what I'm talking about very simply is the fact that for the first time in 36 months, the year-over-year inventory numbers were positive. What that means is that there were more listings this month than the same month last year for the first time in over 3 years. So here's the year-over-year inventory levels. As you can see, the lines are all pretty much red, very dramatically over the last several years. We finally turn a corner, at least for 1 month. We'll see what the future holds, and I don't want to get all crazy about 1 month's data, but this is a good sign. And the other good sign is if you look over the last several months, we've actually gotten, even though the lines are red, the year-over-year inventory levels have decreased, meaning we're getting closer and closer to the inventory from last year. And as you are probably keenly aware, inventory levels in real estate are crucial, and it's very important to review that data constantly. Now again, I don't want to overstate the value of 1 month change. As a matter of fact, Lawrence Yun, the chief economist at NAR, said it this way: "It's important to note that despite the modest year-over-year rise in inventory, the current level is far from what's needed to satisfy demand levels. Furthermore, it remains to be seen if this modest increase will stick, given the fact that the robust economy is bringing more interested buyers into the market, and new home construction is failing to keep up." He is basically saying, yeah, that's good news, but let's see whether it's going to be good news for the long term, because the amount of inventory is dependent on how many houses are being purchased. And very obviously, with the economy doing well, if there's more buyers out there purchasing homes, the level of inventory might fall again. But still, it's a good sign that we're heading in the right direction. Here's a graph comparing year-to-date supply and demand. The blue represents demand, how many buyers are out in the market right now. And we can see the number of buyers over the last couple of months have fallen, so demand is slowing up. We can make the argument that the reason demand is slowing up is there's just not enough houses to show them. And to understand that entirely, but we want to keep looking at this number because maybe the market is slowing up a little bit. Now, if we take a look at the red bars, which again is the supply, the number of listings available, we can see that over the last couple of months that has gotten smaller. And as I mentioned earlier, this month we're actually ahead of where we were this time last year. But again, we don't want to get carried away with only 1 month. However, this may mean some balancing. Now, if we bring balancing to the market, the number one result would be more buyers. So if we bring more listings on the market, more buyers will be able to find the house they want to purchase. And the second result would be if the supply and demand ratios evens out, we won't get that dramatic increase in prices each year. Now, as a homeowner, I wish the prices would continue to go up 6 to 7% a year. I'm sure you would as well. That is until you look to buy another house. Modifying of the appreciation rate will probably be a good thing. I'll spend some time next month diving deep into that pricing. But what it really means across the whole board, now let's take a deeper look into the current inventory levels. Dr. Frank Nothaf, CoreLogic's chief economist, is quoted as saying, "The lean supply of homes for sale is leading to higher prices and fewer days on the market. And supply shortage is more acute for entry-level homes." The reason I wanted to put that quote in there is it helps to understand even though there's an increase in inventory, it looks like that increase in inventory is very much at the upper end of the market. With first-time and move-up buyers, we don't have anywhere near the number of listings for the demand that's there. What we're starting to see is a rather dramatic increase in the number of listings for the upper-end market. Each marketplace has a starter home, a mid-tier home, and an upper home. For example, in San Francisco, an upper home might be $5 million. In other places, let's say in the Midwest, it might be $500,000. So we're not talking about price. We're talking about the top third of each market. And if we take a closer look and break it down year over year, we can see that the supply and demand curve is definitely more acute in the low prices, meaning there's just not enough supply. That's why the low-priced homes in each market are appreciating at a higher rate than the other three price sectors. CoreLogic reported that prices are up 9.4% year over year in the starter home market, while inventory is down 14.2%. So even though the overall inventory, which we pointed out earlier in the nation, is up, the starter home market inventory is dramatically lower. And we believe this trend is going to continue because what drives that starter home market? Young people for the most part. And now we're talking about the millennials. Some factors that impact a millennial's homeownership probability are getting married, which increases their chances of buying a house by nearly 15%. Then chances of them buying a house increase by an additional 6.2% if they have children. So we're talking about the chance of them buying a house goes up almost 25% if they're also married and have a child. And what do we know about millennials? Well, they're starting to age. The millennials are now reaching that age where they are deciding to get married and start a family. So we do believe there will be strong demand for that starter home segment, and we anticipate this demand will continue for the foreseeable future. Millennials' lifestyle and economic decisions are some of the main reasons we currently have a lower homeownership rate than expected, based on our Homeownership Progress Index. According to Mark Fleming, the first American chief economist, it is reasonable to expect homeownership rates to grow as millennials continue to make important decisions, including attaining an education and later in life getting married and buying a home. So again, the chief economist at First American is agreeing, as the millennial generation grows older, they're going to jump into homeownership. Now, the important thing is, what would stop them from doing so? If we're going to start seeing more and more listings coming to the market, we want to make sure that demand is still there. Some of that demand kind of waned a little bit because they couldn't really find the house they wanted, and they might have taken themselves completely out of the market. It's our responsibility as real estate professionals in the area that we understand what might slow that demand down and try to rectify it to the best of our ability. What we want to know is, what is the primary obstacle to becoming a homeowner for those millennials? To answer this, First American did a survey, and what they found when they polled them was 35% said the limited inventory of homes that they liked kept them from buying. Some of the clients moved away from the market because they were just so frustrated they couldn't find a suitable home. Overall affordability is another obstacle. Then down payment came in at 28% of the responses. And finally, access to credit. Let's review those 4 obstacles right now. Because again, we want to make sure that if the market appears to be slowing down, we don't let that to be a self-fulfilling prophecy. We want to make sure that we continue to keep demand strong because listing inventory is going to come to the market. And the last thing we want is all the listing inventory to come to the market and that demand drying up. So let's take a look at each one of these. For starters, limited inventory. Well, as we just said, if you look at the last 12 months, it's been pretty bleak. But let's take a look at June. Again, it's not a big uptick, but it might show the beginnings of a turn. We'll let you know over the next couple of months what that number lands at, but if it's going to start showing a turn, then maybe the inventory challenge that the first-time home buyer is facing could become less acute. Number 2 that they talked about, it's not as affordable to purchase a house. Now that's a myth, and I'll dive into that deeper now. Here's a chart of the consumer house buying power from 1991 to today. Take a look at the blue part of the graph. What we can see is that house buying power, when you factor price and interest rate, and also current income levels, has increased over that time. That shouldn't be surprising. It increased pretty dramatically when interest rates dropped. But now if we take a look at the median house price, highlighted by the yellow line, we can see that from 1991 all the way up to 2005, those two graphs ran kind of, toe-to-toe with each other. It obviously reached its peak of the market, then dropped pretty dramatically after that, meaning that the home prices dropped even though people were still making money. Prices dropped dramatically, and now prices are going back up, shown with the yellow line, but so are incomes, and at the same time, interest rates were going down. So house buying power was continuing to increase. That spread between the blue and the yellow toward the right of the graph means it's still highly affordable to buy a home. But there's entirely too much confusion and negative commentary out there saying, well, houses aren't affordable anymore because they're only taking a look at one factor, and that is price. This is an argument that I think can easily be made right now. If we look to the future, prices are going to continue to go up to some degree, and interest rates are going to continue to go up to more normal interest rates. I think the argument can be made there never will be a more affordable time to purchase a house than today. Looking into the future, it's going to be less affordable to own a home as we move forward. So when people are talking about home affordability, what are they really waiting for? National level title agents and real estate professionals surveyed believe that the mortgage rates would need to hit 5.6%, basically 1 percentage point above where they currently are, before first-time homebuyers withdraw from the market. And before we take a look and say, well, that's just a survey of people and what their opinion is, Zillow came out with a report that says pretty much the exact same thing. Let's take a look at mortgage affordability. Historically, from 1985 to 2000, about 21% of your income was dedicated to your mortgage payment. In 2006, in the boom, that number jumped all the way up to 25.4%. Right now, that number is at 17.1%. Even though prices have recovered, interest rates are much lower than they were between 1985 and 2000. So now monthly mortgage payments represent only 17.1% of your income based on the last numbers for the first quarter of 2018. But even if rates go up to, let's say, 5%, their forecast is it's only going to take 19% of the income. And if they go up to 6%, then we would go over slightly the historic number of 21%. So those agents and title agents that were surveyed, they hit it pretty much on the head. It's somewhere between 5 and 6% where people will start saying, wait a second, it's truly less affordable than it is historically. And they might start questioning that decision. And obviously, not that anyone's forecasted anywhere near 7%. At 7%, we'd be well above that historic number. So when they're talking about affordability, let's make sure they understand. I think a very simple statement to make is this. It's more affordable to buy a house right now than it will be at any time in the foreseeable future. So what are you waiting for? As far as down payments are concerned, obstacle number 3, there is a tremendous misconception over that. Study after study after study have shown people that believe they need a 20% down payment to purchase a house. Well, that is just not true. Let's put this information out there so people realize they might have more of an opportunity than they think. I don't want someone not buying a house because they think they have to wait until they save 20% as a down payment. These are the average down payments for May, which represent the latest numbers available from Down Payment Resource. Millennials put down an average of about 11%. On FHA loans, about 4%. And then conventional loans close to 19%. And then VA, which you can do with 100% financing, the average was 2%. There are also other mortgage programs to help buyers specifically with lower down payment options. So there's a lot of opportunity where they don't have to put down a large down payment of 20%. And I think it's important that we get this information out there to the marketplace. So we're slowly eliminating the issues. Inventory, well, that looks like it's making a turn for the best. We'll find out over the next couple of months. And regarding the whole situation with affordability, again, it is more affordable to buy a house now than it's ever been historically. Not over the last couple of years because foreclosures and short sales drove prices down, but if we go past the boom and the bust, back in history, it's much more affordable now than it was back then. And again, one last time I'll say it, it's much more affordable than it's going to be any time in the future. As far as mortgage credit availability, I realize it's still tight compared with the norms prior to the boom and bust, but every single month it's getting a little bit better. So mortgage credit availability is much better than it was back in April of 2013 and January of 2014. And for the last year, the last 18 months, has remained about the same. And we move forward. People can get mortgages. And we need to do is make sure that we understand that what the alternative is. Here's the median asking rents since 1988 to today. And what we can see is this. if houses aren't going to get more affordable going forward, if that's one thing we know for sure, the other thing we know for sure is that rent's not going to come down dramatically. It might bounce around at the top, but if we look over the last 30 years, somebody signing a lease right now, instead of signing a contract, is not going to be as well off financially, and not just from the payment side. Here's a 5-year change in price by price range from May of 2013 to May of 2018 from the CoreLogic Home Price Index. We can see that over the last 5 years, lower priced homes have increased 52%. That means just from a pricing standpoint, their equity increased 52%. Those first-time home buyers who bought a $150,000 house 5 years ago now have $75,000 in family net worth that they didn't have 5 years ago. And if they bought $1 million house 5 years ago, they'd have 28% or $280,000 more in family wealth. So when someone signs a lease, they know the rent's going to keep going up as it has for the last 30 years. When they purchase a home and get a mortgage, which stays relatively flat, they are building equity as they're making their payments. Now, I don't want to say that without also letting you know there is going to be an economic slowdown ahead. We are just now reaching the longest expansion in American history. A slowdown is due. The economic expansion that began in mid-2009 and already ranks as the second longest in American history most likely will end in 2020 as the Federal Reserve raises interest rates to cool off an overheating economy. However, recessions are notoriously difficult to predict. Forecasters saw the chances of a recession rise back in 2011 and 2016. Both turned out to be false alarms. I'm not suggesting this one's going to be a false alarm because I don't believe that to be true. I do think we're going to have an economic slowdown. I don't like using the word recession, and I will suggest to you that you don't use the word recession either, because using that word paints a negative picture in the consumer's mind. And I'm afraid that picture is going to be the housing crash of 2008. What a recession really is, by definition, is just 2 quarters in a row where the economy is slowed. Here's the Wall Street Journal survey of private sector economists and Pulsenomics survey of economists, investment strategists, and real estate market analysts. What we can see is that for the most part they agree. Going into the end of 2019 through 2020, and maybe at the beginning of 21, a recession is going to take place. That economic slowdown. Those 2 quarters of GDP slowdown is going to occur. We have to be prepared for that. We've had a long run of an expansion, and there has to be a little slowdown. And we have to take a breath. Prices eventually have to level off, but not depreciate, but level off to a certain degree. But I'll keep you abreast of that over the next couple of months in my monthly market report. In closing, I think it's clear what the underlying message is. It's more affordable to buy a house right now than it will be anytime in the foreseeable future. Listen, thank you for your time. Thank you for watching. Comment below if you'd like to see me address other related topics or if you have any questions. And please hit the thumbs up and subscribe button so you can stay informed of my upcoming videos. Have a great day.